Good evening, ladies and gentlemen, and welcome to the Equitymaster Web Summit. This edition of the Web Summit we're calling the Indian economy from darling to damned. If you recollect, somewhere in the mid 90s, Goldman Sachs first put out this idea about BRICS, standing for Brazil, India, Russia, and China. And since pretty much that day or that period, India has been the toast of the town, and all of a sudden in the last couple of months or maybe a year, the whole sentiment has swung from us being so, presenting an opportunity for everyone to a country which really, in some senses, if you listen to the media reports, has no future. So there is a lot of reality to it. There's a lot of noise to it. And in times like these, an Equitymaster Web Summit aims to clear the air. And to help us do that, today we have Ajit Dayal. Ajit is the founder of Equitymaster and also the founder of Quantum Mutual Fund. And we are delighted to have him with us today. Ajit's got vast experience, and in times of crisis, he's the best person to have, as he just cuts through all the noise and brings out a clear picture which you and me can actually then use to make our investment decisions. So with these words, Ajit, over to you. Welcome to the Equitymaster Web Summit.
Thank you, Rahul, for having me once more on a web summit for the viewers of Equitymaster. Again, I hope all of you all had a wonderful Christmas time with your friends and family, and I wish all of you all a wonderful 2012. But as we sort of talk about India and why it's moved from darling to damned, if you will, we'd like to first clarify that India is not the eye in the pigs. When we talk about Portugal, Ireland, Greece, Spain, etc., India is not what the eye stands for. And if you think about it, in August 5th, 2011, the rating agency S&P downgraded US debt from AAA by one notch, saying that it no longer is the safest and the surest bet in the world. Of course, it still is a very, very low risk sort of category of going default, but it lost its AAA status. Generally, when companies or countries are downgraded, their bond yields should actually go up, or i.e. if you invested in their bonds, you'd be losing money. And if you own their currency, you probably would also lose money. But a very strange thing has happened since August 5th till just a few days ago. The US 10-year bond has actually gained 5.6% despite the downgrade in the US. And you can see that the BSE 30 index has lost 21.5% again in dollar terms. And if you look at the emerging markets just a few rows above, the emerging market stocks have also lost about 10%. So in a very strange way, despite the fact that the US was the one that was in trouble and effectively caused fear over sovereign debt around the world, including the Eurozone, and accelerated those fears, the US debt has actually done well, and the US dollar has done well. It should be pointed out that of that 21% loss in the index, roughly 14% is due to the Indian rupee falling against the US dollar. So the Indian stock markets in local terms has not fallen that much, relatively speaking, but the Indian rupee has fallen against the dollar, and that accounted for a chunk of the 21% decline in the BSE 30 index since August 5th. Note the last two rows. Gold has been kind of flattish, down 3.5%, and silver has been dramatically down at about 24%. If you think about debt in India, we've shown this slide before, but it's not a problem as it is in Japan, and certainly as it is in the US. In fact, the Indian debt levels are lower than that of what the US is forecasted to be in the next few years. Again, if you compare India to the countries that are in trouble, to the pigs, if you will, Greece, Ireland, Iceland, Italy, Portugal, and Spain, and even the US, India's debt at the government level is 36% of our per capita national income, and that is dramatically lower than the 150% for Greece or the 161% for Ireland, and even the 66% debt levels for the US. And meltdowns, everyone, you read the papers, you watch the business channels, and everyone's talking about a meltdown in the Indian stock market. Well, India is not in meltdown mode. If you look at the decline of the Indian market from its recent peak set in the end of 2010, we're down about 24%, which is pretty much what the US is down. Also, again, these are in local currencies. We're not looking at the US dollar effect here. So the index was 21,000 in India at the peak in 2010, and the index now approximately is about 16,000. So we're down 24% in rupee terms. In the US, we're talking about the Standard & Poor 500 index moving from 1565 down to 1193, down 24% in dollar terms. So I'm not using currency, but just showing you that effects of share prices in nominal terms in their own currency in the various markets. So India is not in meltdown mode, and we should not worry about a lot of the hype out there in the newspapers. Moving on a bit to the macroeconomy, the same thing. When you read the papers or you watch business channels, and I would encourage you not to watch too much of business TV, it sounds a lot like the US economy is booming and the Indian economy is collapsing and we're back to some 1991 crisis levels. Well, I think we're far from it. The line on top is India's GDP growth rate the quarters before Lehman went bankrupt, so the end of 2007. And you can see, yes, it slipped to about 6% for a few quarters, and then it's picked up again, and now it's down. But a 6%, 6.5% number is far superior than the global averages, and is also far superior than what's happening in the US. The Indian rupee, we've seen from its peak in December 2007, when it was about 39 from its recent peak. We saw the Lehman crisis and the rupee collapsed all the way to 52 and spot 0.5, and then it strengthened again to the 45 levels, and you can see the move again from August when it's weakened very sharply from the 45 levels to 53. So it's nervousness, the same nervousness on the left side of the bar from December 2007, when Indian 10-year bonds issued by the government of India were yielding 7.7%. Then you had the Lehman crisis. Everyone in the world cut interest rates, including India. But interest rates in India were about 6.5%. The rupee collapsed. And now again, you're seeing interest rates having peaked at 8.8%. So you're earning more money in nominal terms. You're earning 8.8% in Indian bond if you buy Indian bonds, and the rupees become weaker, and you were earning 7.7% in Indian bonds in 2007 and early 2008, and the rupee was stronger. So money flows tend to follow where interest rates are, and yes, money flows also follow where inflation adjusted interest rates are. And if you believe that inflation adjusted interest rates in India are going to be around the same of where they've been all these past few years since 2007, which is roughly 2-3%, then you should be seeing a rupee appreciating in a normal market. But as the left side of the chart shows, when there's panic, like there was in the Lehman crisis, the rupee can weaken for all the emotional reasons, not for fundamental reasons. Lending rates, and if you go back a few years in history, you'll find that inflation has been up and down, and interest rates have been all over the place. And as we show in this zoom in on the graph on page 11, that despite high interest rates between 1996 and 2001 and low inflation, so the real interest rates, which is the Indian 10-year bond line on top and the Indian wholesale price index inflation at the lower end, one minus the other, even though real interest rates may have been 6%, 7%, 8%, GDP still grew very strong at 6% per annum on average over that 4-5 year period. So high interest rates do not necessarily slow down GDP in India. That's because a lot of the Indian economy is totally delinked from interest rates. For most farmers, for many people in rural India, what happens to interest rates set by the RBI and by the banks do not have a day-to-day impact on what they're doing or on their consumption patterns or their behavior patterns. It is really for Indian industrialists and for the captains of industry that these high interest rates matter, because the capex cycles get affected. But rural consumption and rural demand is on the margin, as of now at least, driving India's GDP growth, and we don't see any problem with that in the near term. Just want to bring out a slide. While I was traveling the US in May, I could see the date here, May 9, 2011, there was this article in the US about onion prices in the US, and it shows how onion prices went up and they spiked from around first quarter, from 10 cents a pound. They went up to 30 cents a pound, and they came back very sharply down to 10 cents a pound and even lower by the end of 2010, early 11. And this is a Wall Street Journal, which is the biggest proponent of capitalism in the world, I would imagine. And there's a very nice comment at the bottom that I love to show everyone. Futures trading in onions, unlike other farm goods, is banned, which prevents the pungent bulb from being used as an investment vehicle. A very telling statement. Now, we have futures trading in oil, in wheat, in rice, in cotton, in sugar, and cocoa. That leads, in my opinion, as the Wall Street Journal is indicating very clearly here, to speculation and to very sharp movements in prices, and sometimes to artificial movement in prices. I'm not worried about the sharp movement, because a sharp movement can be demand-led or supply-led. But I would worry a lot if it remained high, like it does, because people are speculating in something. So, we talk about onion prices in India and about inflation in India. 12 months ago, November, December 2010, the price of onions went to about 60 to 80 rupees a kilo. Please check your grocery bills today. It's below 15, 20 rupees a kilo. In fact, the wholesale price has come down to 5 rupees a kilo. And there was an article in the third week of December in India that the government has been asked to step in to set up a minimum support price to buy off the extra onion from the market at 5 rupees a kilo. This points to me, this is to be very carefully understood, that the cyclical nature of food prices will never go away anywhere in the world. If there is a bad crop of onions like there was in the last quarter 2010 in India, and obviously in the first quarter 2010 in the US, the price of onions will go up because demand is more than supply. The farmers will react to price. The price is a signal. When onions go to 60 rupees a kilo, guess what the farmer plans to do next time around? He or she will plant more onions, more acreage under onions. Of course, there's soil and weather to support it, but that's what they will do. They will put more acres under onions, and then lo and behold, one harvest later, you'll have extra supply of the onions, and the price will come down. Now, guess what the farmer will do next time around? He or she will plant less onions, and therefore the price of onions is likely to increase in 12 months' time, because the supply will come down and the demand will not have changed much. So get used to high and low prices of commodity products, unless you can, through genetic engineering and better supply chain management, you can sort of ensure there's storage of surplus onions in 1 year, and that they don't perish and they stay till the next year when there's a crisis. So whether it's for rice, wheat, soybean, cotton, whatever you may call it, I think agricultural prices will go up or down, and it's true for rice, wheat, everything, like I said. So please don't be alarmed at that. It's a fact of life, and you have to adjust your mental view, if you will, on that. Looking at the BSE 30 index, going back to 2005, when the second version of the BRIC story that Rahul spoke about in the start was sort of popularized by Goldman Sachs, emerging markets did very well. Indian markets shot up to a peak. They came tumbling down post Lehman, and then they picked up again post green shoots in March 2009. They got the swing up, and now again there's been concern from the last peak of November 2010. There's been concern about inflation and then sovereign fears, etc., etc., and the markets have come down. Note, you still have made money, from the time that you bought. You would have lost money if you bought in the peak of 2008. You would have lost money if you bought in the peak of 2010, and probably a few preceding months, prior and this thing prior to those peaks. But you still can make good returns in our view if you're patient. But these are very, very volatile markets, and like the price of onions, like the price of wheat, volatility or wild swings is here to stay, given the nature of capital markets, and that's not going to change in a rush or in any kind of hurry. So we continue to believe that the Indian economy is very delinked from the global economy. We've shown you all some of these slides before, that very little of what is lying in American or European homes is made in India, and very little of the technology or the end product that is sort of linked to home purchases is outsourced to India. And therefore, in our opinion, a completely dead Western consumer should not have a dramatic impact on the Indian economy. It will always have some impact, we fully recognize that, but I would be more worried about China, which exports and populates US and Western European homes with made in China products, than I would with the state of the Indian economy if the US and Europe were to remain in a freeze for the next few years as they have to repair their balance sheets. This colorful slide again indicates how the stock market has moved over time periods, again from the December 2007, Jan 2008 peak. The first bar, fears of inflation, brought the market down. Inflation eased by June of 2008, and the Indian stock markets began to recover in that small yellow bar. And then you had the Lehman crisis, and in 5 weeks, the Indian stock market lost about 55%. The Indian rupee lost about 20% over 3 months. And then you had the green shoots, and from March 2009, Indian markets recovered. Around May 2009, that sharp movement up is the election results being announced, our euphoria of having Prime Minister Manmohan Singh as a great reformist. And then you've got the stock markets running up to a peak of October, November 2010. Then again, fears of inflation brought it down. Greece sovereign debt fears, and of course currency movements have brought it down again, or fears of further sort of currency weakness in India has brought it down. So kind of a panoramic view, a colorful view of where we have just been. A lot of this again is a function of foreign flows. Note the last row. May 2010, a year and a half ago, was when Greece actually first was seen to be in trouble. Foreigners sold $2 billion that month, and the Indian stock markets fell about 7.7% in that month. And you can see in 2008, after Lehman, foreigners sold 12 billion, 11.9 billion. Indian markets fell 60.7% in dollar terms. Again, about 20% of that was currency. In 2009, foreigners bought 17 billion. Indian markets recovered very sharply. In calendar year 2010, again, this 2010 number of 29 billion purchases was really distorted by the fact that there were 4 months between July to November where foreigners bought about $25 billion worth of shares in 4 months. So that 29 billion was not roughly 2 billion every month. It really was 6 billion a month for 4 months. And that's what made the Indian market sort of go up. And now year to date, as of end November, foreigners haven't really bought or sold much, 0.4 billion. And the Indian markets are down 31.8% in dollar terms. And roughly, again, like I said, 14% of that is currency. So roughly about 17-18% in rupee terms for local investors. The red line in this chart shows again the peak of the market from Jan 2008 all the way down to Lehman, and then the recovery. The blue line takes the peak of end October 2010, and again high inflation makes the blue line come down, and then fears about Greece makes it, again sort of come down and slip downwards. So are we quite in the same panic mode as we were around the Lehman times with the red line collapsing? Answer is no. Could we get there? We could. If you're a foreign investor investing in dollars, you're closer. because as a foreign investor, you've lost more money because of the currency moving against you. So when you translate the BSE 30 index back into dollars at a higher exchange rate of 53 to a dollar, as opposed to 44 or 45 to a dollar, you've also lost that rupee, loss in terms of your total. You get less dollars for the same amount of rupee. So you can see that the blue line is in some sense moved closer to the red line, but not dramatically, closer yet. It could get there. We are not saying that it cannot. We're not saying that it can. We have no clue where the markets could go. It could panic. You could see the markets falling 20-30% in 1 week. I've often said on TV, and even when I made my forecast of the market being 28,000, 29,000, 30,000 by July 2012, there were enough provisos for those who followed the articles and heard what I had to say, even on TV or on TV interviews, that if foreigners sell a few $1 billion in a week, the index could be 8,000 very quickly. So recognize that foreigners will buy and sell for their own reasons, and sometimes they get excited, as you can see here. They buy and the share prices go up. They get concerned and share prices go down. And we've often said that the value of an Indian company is a function of what happens in the Indian economy, and the price of an Indian share will be a function of what the foreigner does or does not do. But for those who are looking at the long term, and Quantum as a group, and certainly us as when we talk to our international clients, to the FIIs whose money we manage in India or whose money we advise in India, we always talk about the long term, and we always have flagged these risks that there could be deficits which could lead to inflation, which could weaken the currency. These are all risks that we have highlighted. This slide has not been changed for the last 7 years. We don't think there's any reason to change these slides for the next few years. If you look at the long-term trend, India is in the yellow, second from the bottom. We commanded about 25% of GDP 600 years ago, 500 and whatever years ago. And you can see how that shrunk as the Industrial Revolution took place without us. And then again, as the reforms in the world took place without us. But there's a slight expansion. China, the same thing. China was a big chunk of the global economy right on top in red. And it's now expanding again. The US as a country was only born towards the last 5 bars on the right. So the US, born in the year 1776, if I have my history right. I don't remember. If not 1876. No, 1776 by history, right? So, that only expanded later on as an economy, and you can see how it grew and dominates still the world as the single largest nation in terms of GDP for about, I think, roughly about 30% or 28% of global GDP is from the US. If you look at India, over the last 31 years across 9 governments, 6 of which have been coalitions marked by the asterisks or by the slight pink shades, India's economy in real terms has grown by 6.2% per annum on average. So we don't, we have no problem in our view. We believe that for the next decade or so, India will continue to grow at 6.5, maybe even to 7% per annum. We have never been believers of the 8, 9 or 10%. So therefore we are not disappointed when we see GDP forecasts being lowered. Again, this is from the Goldman Sachs BRIC report, just to give another view of how the Indian economy from the period 2005 to 2020 would have increased in size by 70%, and as would China, and how the Eurozone and Japan would shrink, and even the US would shrink. So you should not be surprised with what you're reading about now. It is occupying headlines, but for people following long-term trends, this was expected in terms of the slower growth in the Western world and the larger growth or the more rapid growth in the emerging world. The BRIC report, I think, Mr. Jim O'Neill, I think it is the chairman of Goldman Asset Management Asia or something, recently made a comment that he was that amongst all the BRIC countries, Brazil, Russia, India, China, the biggest disappointment was India. And I take issue with that, because sometimes disappointments are a function of expectations. So if your expectations are wrong, your disappointments will definitely be there too. And I think in the Goldman report, they took the demographic dividend that India will have 120 million youth by the year 2025. Young people, they will work towards, they will add towards India's GDP versus an aging China and an aging Western world. Well, I think what they forgot to talk about was how those young people will actually get jobs. If you hang around street corners doing nothing, you will not add to GDP. You in fact add to social tensions and potential crime. And our biggest issue over the years, this is not a new slide at all, has been the fact that that there is no government policy in place to actually create jobs. So we have got NREGA, we've got the Mahatma Gandhi Rural Employment, this Guarantee Act. We think that is fantastic. We think there may be leakages, and there are leakages, no doubt about that. Half glass, whether the glass is half empty or half full is always a big sort of debate. And yes, it can be improved, and you can find ways to cut leakages. But I think by allowing people a guaranteed job and a guaranteed income of 100 rupees a day for 180 days in a year per household, you're effectively setting a minimum wage price across the country. A person, even if he sits at home and does nothing and collects 100 rupees a day, will be reluctant to come and work and live in real estate construction in Bombay or in Delhi or in Bangalore or in Chennai unless he or she is paid a lot more, because after all, once he comes to Bombay or Delhi or wherever else, he has to find a place to live, and he's probably captive to some slum lord who's extracting a rent from him, and he's got the further hardship of being away from his family and his relatives. So his demanded price to leave his town or his village to come to bigger towns has actually increased, and that's good, because that sets the correct price, if you will, of labor, in my opinion. And when you distribute money, hopefully for work and not just sitting at home, then you actually creating wealth at rural levels by clearing shrubs and trees and bushes and making a dirt-filled road. That's still productivity compared to doing nothing at home. So as long as there's some work being done, and one should try to find ways to make NREGA more efficient as opposed to sort of stop it. So in my view, by creating these jobs in rural India, you also remove the pressure on urban India. There is, as we all know, not enough housing, not enough water, not enough power in most Indian big towns. So by creating wealth in rural India, you're actually helping the growth of urban India in a more planned manner. Of course, policy making remains a big problem in India. There is no leadership in New Delhi, has not been for the last year and a half, and whatever leadership was there before that seemed to be a sale of national assets like oil and gas and coal mines and iron ore and spectrum on the cheap. So bad kind of leadership and bad examples. But that's where we are. In terms of the trade numbers, oil imports are a big thing in India. We've highlighted the year's estimates April to March 2012. We're expecting a current account deficit of 55 billion. This is after software exports of roughly 62 billion, which is the row above. How will this be funded? Well, foreign direct investment in multinationals who come into India. Last year on the extreme right was 7 billion. This year the expectation is 15 billion. As you can see on the left column, it's already 12 billion roughly from April to September. So it could touch another few, could get another few billion between now and March. The FII investment in stock markets, that is the unknown. On an April to March basis, it was 25 billion 2011. It is nothing today, or 0.5 billion as of April to September. And expectation could be that it gets to 5 billion or so. That's an expectation, an assumption. FII debt was 8 billion last year. Is April to September is 2 billion. It could probably cross 8 billion because interest rates in India are also high. The big one is bank debt and credit. It was 23 billion April to March of last year. So far it's about 15 billion. But with the Eurozone crisis, people are not sure whether European banks have enough money to lend to Asian economies and Asian countries, including India. So that's an unknown, whether it gets to 25 billion or not. And then you have the NRI deposits and other flows that come in. But the total inflows are expected to be 52 billion. So you need 55 billion to pay for your oil imports, your gold imports, and you get some of it back because you export software. So you've got a deficit of 55 billion, and it's funded with hopefully about 52 billion. So you've got a 3 billion shortfall. The Reserve Bank of India has $300 billion of foreign exchange. So if they had to cough up 3 billion, that's 1%. They would lose 1% of the FX reserves if you went to the RBI to collect the $3 billion from them, which is nothing. So we think a lot of the focus on the rupee and the fall of the rupee is probably the RBI's fault for making a statement, which they should not have, that we will not step into the markets and we will allow the rupee to do what it needs to do. Generally, when central bankers make that statement, it allows speculators to do exactly what they want to do, knowing that the central banker is not there to support the currency. I am not arguing for supporting currencies. I'm not arguing for weakened rupee or strong rupee. All that I'm just saying is that when a central banker makes a statement that we will not step in, it sends a signal to speculators. It's an open field. Do what you want to do. There's no umpires watching you. Do exactly what you want, and there's no rules in the game anymore. And so that's kind of not a good thing that the RBI did. I think the RBI's act of increasing interest rates throughout the year was very good and was very necessary, because the government is doing nothing on the other end at the fiscal side to prevent inflationary pressures. So the RBI was kind of forced in my view to do something. India, we believe, is a diamond in the rough. Look at the last 10 years, what the BSE 200 index has done, the BSE 30 total return index with all the dividends and rights issue benefits put it back in, and it's done much better than anything out there in the world. So we think India is a fantastic long-term story. The one-year numbers don't look good, but live with it. The wild swings, as we indicated before, in Indian stock markets will continue, but over cycles, India's gap with the world will keep on widening. That's our opinion. That's our view. That's what we are telling our long-term FII clients. And it is on the basis of that which I think the FII long-term money is finding India pretty interesting. Again, there are a lot of choices in India. We've got across different sectors, unlike many emerging markets. Like Russia is mostly oil and gas. Brazil is oil and gas and metals and materials. India has a wide choice of sectors for FIs to buy or sell stocks from, and that helps them in making their decision in terms of country allocations. The Indian stock market, again, we're looking forward 2.5 years, because March 2012 is somewhat of a given. 9 months of the year are nearly over. So looking out March 2012, the Indian market's trading at about 11.76 times PE ratio, and the EPS growth rate as estimated by the Bloomberg consensus analysts, what we get is not by us. These are all the sell-side brokers that we capture data from on Bloomberg. They're showing that each year the EPS will grow by 13%, which is a decent number. But, I think that what we warn long-term investors is recognize there are changes in India. There's the old style, which sometimes, of course, still works. Look at the issues I just mentioned about iron ore and oil and gas and spectrum, and of course, connections and friendships certainly matter there. But what we love to do is identify companies and businesses on the right-hand side, which understand their market, they know their customers, they worry about the competition, and it's the consumer who decides whether they succeed or whether they fail. It is not friendships with governments that decide in the long term what they do. This is a very interesting slide. Again, I've just taken a few groups. There are many other groups, but there's not enough place to put them all in. But it just shows on January 7th, when Mr. Raju of Satyam announced that he was getting off the back of the tiger and had $1 billion fraud in Satyam. Satyam fell, I think, by 72% that day. The the Nifty, which is shown as S&P CNX Nifty, fell by 6.18%. So we've shown that in every box over here, and we just shown how different companies reacted to that panic in the market. So in the Tata Group, for example, there were some companies that didn't do too badly. I mean, Trent, third from the top, lost only 0.6%. TCS lost only 0.3% that day. Tata T 0.86%, etc. And then you had Voltas, which lost 12%. Rallis India lost 9.9%. So you had across the spectrum some companies losing less than the index, some companies of the Tata Group losing a lot more than the index. In Mukesh Ambani, Anil Ambani, all the companies lost more than the indices for various reasons. But I think that what this slide really shows is that there can be stocks that may not fall as much as the market does on bad days or bad times or bad quarters or bad years. And the job of the analysts at Equitymaster or the fund managers at Quantum Mutual Fund or of any fund house is to build a portfolio of stocks across risk spectrum, across market caps, what we call diversified long-term equity funds, and build a portfolio which works for investors in the long run. I'll just steal a slide showing Quantum long-term equity fund showing up as QLTEF over there. Just kind of recognize that in a risk-induced world, a fund like Quantum is unlikely to do well. But when people worry about risk and pricing of risk, as we've seen from July 31, 2007, the total return that came out of Quantum Long-Term Equity Fund was 13.6%, and that of the index BSE 30 TIR, again all in dollars, was minus 15. The emerging market free index, which is shown up as MSCI EM free, was down 7. The Morgan Stanley Capital International World Index, shown up as MSCI World, was minus 13.8, and gold has done 162.9% plus. Oil, of course, a row below, has done 28.3. So, different asset classes and different kind of assets will react differently over cycles, and you can choose your time periods to see how they perform. The BSE 30, we're not big fans of ETFs. People have asked us about this a lot. I wrote a recent Honest Truth on this, that an ETF has to underperform the index because the index makers make so many changes in a year that there's a transaction cost to replicate the final index each time an index is changed, an index component is changed. So there's a brokerage cost you're buying and selling every time. And therefore, to track the index, you're paying all these brokers and paying all these fees, plus this STT, etc. That over various time periods, 100% of ETFs which try to mirror the index without any cheating definitely have to underperform the index. Whereas it is possible that there are some actively managed funds by different fund houses where investors, through proper diligence and just watching the papers or asking their advisors, can actually select and build a basket of stocks. The other important thing to note is that you must be diversified across asset classes. I think in the Quantum AMC Path to Profits, they speak in detail, and you can go to the website and you can look, and I'm sure you can see it over there. But I've taken one slide from there to show how a mixed portfolio of equities and gold and liquid fund has done since 2008 November, just to show you, where things are. And it's done reasonably better because it's got gold in it, because it's got liquid fund in it. So liquid fund doesn't come down in a stock market decline. Gold has actually gone up. So there's some cushioning going on. And people need to realize that they have to always be diversified across asset classes. The discussion should never be, which share should I buy or which mutual fund should I buy. The discussion should always be, what is my asset allocation? And within each asset allocation, should I be in the market? Is the market expensive? Is it cheap? Are the PE ratios high? Are the PE ratios low? And is it a good time to, add more or take some allocation out of stock markets? So that's what the investor's query should be. And you can see in this chart going back about 10 years that the PE ratio for the index was roughly 9 times in March 2003, around the time of SARS, and was about 9.8 times again time of Lehman, and now is a little below the average of 17 of the last decade. So not cheap, but not expensive either. It's certainly not a fire sale like it was in 2003 or in 2008. We still stand by, just looking at the data, I still stand by the data using the estimates by analysts out there. These are not quantum estimates or Equitymaster estimates. So the expectation of the analysts is that the earnings per share of the BSE 30 index will be rupees 1198 by March 12, and 13,399 by March 2013. And again, using just drawing the lines of where things go, and if they were to meet, recognize they have not met since 1999-2000, but if they were to meet, what would the index be? That's what it would be. So please recognize, I've got a lot of flack for this. I stand by it to the extent that it's a combination of earnings and money flows. Am I saying this is what the index is going to be? No. I don't know whether, it may get there, it may not get there. It may be 8,000 next week if FIIs sell $3 billion in a day or $6 billion in a week. But this is what it could be. As a long-term investor, draw your charts out to FY 2013, 14, 15, 2020 and get a sense of earnings. And then you will see that a 15 to 18 to 20% per annum long-term return in stock markets is realizable, and it has been done. From the decade of 1980 to 1991, you would have made 5 times your money on the BSE 30 index. From the decade of 1991 till about 2000, you would have made about 4.5 times your money in the BSE 30 index over 10 years. From 2001 till 2011, you would have made about 5.5 times your money in the BSE 30 index. So you can make money over long periods of time. Follow the earnings, follow good businesses, follow good managements, recognize the risks, recognize that the 120 million youth are a problem unless we find jobs for them, then they become an asset. Recognize that what happens in the US and the global economy and how the central banks behave around the world is a huge problem also for us, or an advantage, whichever way. If interest rates are increased in America, or if there's a fear factor and people jump back to US dollars because they think that is safe, wrongly in my opinion, then Indian stock markets will go down. If people flee the US and they look for safety outside of the US, Indian stock markets will surge like they have in the past. So recognize all that. Stay, in my view, with a mixed allocation like you would in the US as an investor, by having bonds, which is, fixed income, PSU bank deposits. I'm not a believer in gilt bond funds per se. I prefer liquid funds and I prefer fixed deposits as my fixed income investments. Real estate, for those who really want it, I'm again not a big fan of real estate. I believe more in equities, and of course, as we've said before, we always like gold, and that up to 20% of your allocation of your total asset portfolio must be in gold, in our opinion. There's a disclaimer that's too short to read, but it relates to the performance numbers I've given for quantum. Recognize that if ever you buy any mutual fund, including quantum mutual funds, you must understand the fund manager's background, the fund house's background, their philosophies, their approach to investing, and of course their track record, and recognize that nothing that is said about the past can ever be sort of said with any certainty about the future. So with that, I will turn over to Rahul for queries.
Thank you, Ajit. As always, very enlightening. I think we've got a lot of questions, and of course, a lot of them revolve around the predictions, the sense you've given in the past of how the BSE index could move. But let's start with a topic I think which would be interesting to get your views on. Of late in the newspapers, there have been reports of India's export numbers being rigged. Were you surprised, and what's your take on this?
I don't know if the numbers are rigged. I mean, when you talk to people who are independent economists who track this, they had been saying for some time that the government needs to change the way it compiles data. And it could have been a genuine error. And again, keep in mind, it was a $6 billion error on about $130 billion export number. So that's not rigging. I mean, that's a 3-4% error or a 5% error which is going on in the system. So is the data reliable? Probably not to the extent of 5-10%. Is the direction of the data reliable? Probably is. But, I don't think we need to beat ourselves about the fact that there was a 5% swing in an export number. It just shows that the government needs to, probably talk to groups like CMIE, and in fact, as you know, we have a lot of respect for a group like, like them, like CMIE, and groups like them to build genuine databases which are statistically more sort of accurate and reliable.
I think it becomes interesting, especially in the context when you talk about all the black money. The other day, an Equitymaster reader sent across this comment. I think it was in the 5-minute wrap-up on The Honest Truth. He said that the rupee is going to hit 80 to $1. And the reason is because that's the time the black money is going to come back and they're going to pay the tax, and net, they'll still have all their money.
Yeah. I mean, I am a believer in conspiracies. I no longer believe that everything that you see is fair and transparent. I believe there's an ulterior motive behind most things out there. So I'm getting more skeptical, I guess, about what we read and see. But I have no idea and I have no view whether there is an intention to push the rupee to 80. We personally, when we talk about where the rupee is among the senior team in quantum mutual funds, our view is that, and it could be wrong, our view is that the rupee will actually appreciate back to 47 rupees to $1 levels by March 2012. And we think largely because the speculators were given an open hand by the RBI statement that we will not interfere. And exporters have had no urgency to hedge their export receivables, to sell the dollars that they will get into the system. So the supply of dollars has been held back, and the demand for rupee continues to be high. So as exporters bring their dollars to the market to sell, to convert to rupees, the supply of dollars, like the supply of onions and wheat and rice, will increase. And the price, the exchange rate, will come back to a more moderate level of 47 in our view. And this we all expect to happen by March 2012. But keep in mind, it took only 2 months for the rupee to go from 45 to 53. So it can take 2 months to go back. So please don't be skeptical about it. It can happen.
And then that should be good news, at least for the importers. Let's look into a little bit of the macro issues. What's your call on, now you're telling us rupee dollar, you think in the next couple of months, if we could move back to parity. Long term, what do you see? Do you see this do you see a one-way trend, or do you see the rupee hovering around where it's been hovering?
No, I think the Indian rupee will remain, 45 rupees to $1 as base, plus or minus 2-3%. To become a strong currency, India needs to export a lot, so it gets a trade balance. That is unlikely. Until you build up your ports and your power plants, you will not attract multinationals to use India as an export base. Or you have some great service industry, which they all want to come here, right from tourism to software. So you built up the software industry, you've got $62 billion of software exports every year. You've got a very small tourism industry. So if you bring in those sort of invisibles, as they're called, into India, then yes, you could have a strong currency. But I would not bet on India being a strong currency economy for the next, for the foreseeable future.
You mentioned about infrastructure, and these days I think every day you have some industrialist, entrepreneur or the other complaining about a complete lack of movement in terms of policy decisions, and that's holding back investments. Now I know in An Honest Truth in the past you've given a different interpretation of that, which is that people probably don't know who to bribe. What's your understanding of the situation from two perspectives? One is from the Indian perspective, and two is how is the serious money investor outside looking at India?
Well, I just met a very senior executive of a very respected in Indian firm, just a few hours ago. And I asked him, I said, so what's your view? And he began, with the normal stuff you read in the papers with, oh, how bad things are and nothing's happening and India looks difficult and all. Then I probed a bit. I gave him my views on how I think that whether you're ACC selling cement or whether you're Bajaj Auto selling two-wheelers or whether you're Nestle or Lever, you're actually doing quite well. And at the end of an hour discussion, he agreed that the Indian economy was not doing as badly as people made out to be. And even his own firm was not yet affected. His own firm was doing pretty well. The share price is not, but his firm's, is still doing quite well. But he did say, and he's right, that policy making has come to a freeze. We all know that. Now, policy making being in a freeze by itself is not bad. If policy making remains in a freeze for the next 2-3 years, that is bad. The question is what happens next. If it really upsets me no end every time I see Prime Minister Manmohan Singh waving. He's so stiff, he's like a puppet. It really angers me why he's not moving and doing something. Policy making has been frozen as the BJP read. Again, I don't care about politics too much, as many of you know. When Prime Minister Manmohan Singh was re-elected in this recent election of a few years ago, I was very ecstatic and I expected a lot from him and from the party. So, I don't have any negatives or positives either way. But it upsets me no end that politicians, when in power, do not seek consensus even from their own allies, let alone, then going to the opposition and trying to seek their support. And I think Mr. Jaitley of the BJP made a very pointed statement a few days ago. He said the Congress cannot get their own house in order. Why are they blaming us because we're not supporting them? And you look at the FDI policy,
Retail,
their own, you look at FDI and retail, however you may like it or may not like the policy, they try to bring it, and without even bringing it as such, they had to drop it, because one of their own allies said, we're not going to be anywhere close to this bill. So policy making is frozen because there are a lot of arrogant people who believe they have the answers and the rest of the country must follow. It is not harmful to be arrogant. It is harmful to be arrogant and not get your party, allies to follow you. That is the problem. So have all the arrogance you want, no issue. Discuss, bring them to the table, bring them round to your point of view and move ahead. Whether the policy is right or wrong, time will tell. But this is embarrassing that you can't even get your own allies together. And yes, there is a freeze. So like I said, it's a question of what comes out of the freeze. If it's going to be this sort of stuff, it's a disaster. Because much as there is a vibrancy within India, we certainly need power, we certainly need ports, and we need roads, and we can't build those till there's a government framework in place. And that's where policy making comes into play. I keep on getting to the example of real estate. Real estate in Bombay city, from what I understand, you need 57 permits to get a project off the ground. 57 permits. Why not cut that down to 5? And when you talk to developers or real estate brokers, they tell you that the cost of bribing has gone through the roof. Because if the cost of a bribe was 100, now the person who wants a bribe says, boss, give me 300 because my chance of getting caught is higher. So the risk return has to be trade-off. We all know risk and return. You buy small cap, you want more return. If you get caught in a bad small cap, as many people have been caught in 2011, you can lose 80% of your stock price, 60% stock price. So if I take a bribe of 100 and go to jail, okay, my family gets only 100. And I know I have a good chance of going to jail because of this sort of, because of the Anna Hazare movement and stuff like that. So now if I want a bribe, I want a bigger bribe. So the system, the policy making has not yet come out in the positive. If after policy freeze, the end result is bribes are 3 times more expensive, that's a disaster. Absolute disaster.
Tell me something. The situation that we see in India right now seems to be pretty unique. Can you take us back in history in India where you've seen such a similar situation where everything is just frozen up?
India's been in deep freeze for a long time. I don't think we should fool ourselves about that. India's policy making has been largely through crisis. People are comparing this to July 1991. It's not July 1991. In July 1991, India was bankrupt as a nation, or as close to bankrupt as we could get. And we were forced to do things. Mm-hmm. I don't think we're anywhere close to that. And we have had policy making right from Vajpayee's time of building roads to the telecom policies that have evolved over the years. So there has been policy making on the margin. Uh-huh. There has been no great policy making which has carried through governments. Mm-hmm. So if Vajpayee's government brought something in telecom, someone else modified it next time around. If he wanted to build something on roads, someone else came and modified it. They hijacked it for whatever reason. So again, I don't want to name parties or people. That's not the point. But what the government has done, and the policies that I love that are in place, and I hope they sort of gather in size and storm, is the Right to Information Act. I think that is fantastic. And I think the other policy framework has been this minimum rule. It has been this sort of NREGA. The National Rural Employment Guarantee Act. I think those are fantastic policies. I think you need to have more transparency in the way they're managed. But those are two policies that I love.
What do you think about the right to food bill?
I think the right to food, you please recognize we live in a country where 300 million people or some such number live below the poverty line. Mm-hmm. And please recognize that for the next 20 years, there has to be a transfer of wealth from those who have money to these 300 million people, either through taxation or through schemes like NREGA or through right to food bill or right to education bill or any kind of bill. There has to be a transfer. If you build an economy where 600 million people are very well off, or much better off than they were say in the year 2001 or 2011 in the future, and if you build an economy where 300 million people are very, very poor, that's a disaster. That's going to be social problems big time. So you have to build a more equitable economy, which is why I've said a 9% GDP growth rate with theft of national assets, of oil, gas, land in SEZ or whatever it was, iron ore, coal mines, whatever, is far inferior, and it's far better to have a 6.5% GDP growth rate with better transfer pricing of these national assets to the corporates that want to exploit them and build business around them.
Okay. Let's move on to some questions involving money. And I think this is a fantastic question. One of the readers has written in that I'm a long-term investor and I can wait for up to 10 years. However, I presume that 5 years is too long. 5 years too is long-term. And he notices that in the last 5 years, his bank deposits have done better than his stock investments. So, what's your view on this? Over a 5-year time frame, deposits have done better.
Well, we showed that chart of the BSE 30 index from 2005. So again, it depends upon what shares you buy and what kind of stocks you bought and all of that stuff. There's no doubt about that. Those influence the rates of return that you would have made. But in 2005, the index was about 6,000. And you're talking about an index even today of close to 16,000. Yeah. So by the time you add your dividend yields of 1.52% a year, you're actually not done too badly. Okay. So it depends. Again, point to point, I can't give you a number. And it's possible that point to point you may have done better. But it depends what shares you buy and what you've done. But just look at the index graphs, and I've not done the data points on this, but I'm sure that there are more days that you would have bought shares in history. I'm going back 5 years or whatever it is, and you would have been a winner. So if you look at the slide on 13, index is 6,000 in Jan 2005. I mean, you made 2.5 times your money, 3 times your money. Not bad. I don't know, bank deposits have given you 3.5 times your money in 6 years. They couldn't have. Right? So again, depends on which share you bought and which fund you bought, and you bought a telecom fund and an infrastructure fund and a tiger fund and all those idiotic funds, then yes, you probably are going to suffer. But if you bought a diversified fund which typically tend to follow the broad indices, you should have done better off.
I think that brings us to the point that if you do not have the right resources to pick stocks, or you don't have the acumen to pick stocks, you should probably avoid that, because even though, like, we're seeing how the stocks have moved, you've not really benefited from it. So you need to be careful there.
Yeah, and again, stock to stock, if you look at the peak of HDFC Jan 2008 and the peak of ICICI Bank, to give you two examples of Jan 2008, and look at the share prices today, ICICI Bank is way below the peak, and HDFC and HDFC Bank both have done better. So a lot of it is stock selection, which is why I showed that graph about how markets react in times of stress. When you had that Satyam fallout, the markets gave you a view on how they treat different stocks. So as an investor, study that chart carefully. And again, I've just given you some examples. There are many other business groups that you should look at, and many other stocks you should look at, and see how the market reacted in stress times. And if you don't want stress, then don't buy those stocks that were hit and did worse than the index during those bad times. That's the moral of that sheet.
Okay. Moving to foreign investors, we know that there's the hot money and there's a really long-term serious money. What is the outlook of the long-term serious money when it comes to India?
I think the long-term serious money has not even entered India.
Okay.
I'll go back to the numbers I've used before. There's about $15 trillion of money lying with the pension funds in the Western world and Japan, in the OECD nations. If those 15 trillion pension fund assets, if they were to allocate 1% of their money to India, that is 150 billion US dollars. The cumulative money from all FIIs, or so-called FIIs as of now, is $85 billion since the FI rules began, or at least since 2003, right? So now we're talking about 150, nearly 2 times that money has yet to come in. And those are the kind of clients that I spend a lot of my time traveling and trying to encourage to invest in India. Their allocation to China is something like 4 times or 5 times that of India today. It's in places where they have India. There are many funds, there are many pensions that have money in China and 0 in India. But those that do have in India, the ratio would be 5 to 1, 4:1. Okay. For most, it will be something to 0, like because India will be 0. But even those that have, India is a minority compared to China. That is what, in my view, finance ministers need to change. Finance ministers need to go out and meet the pensions and explain the India long-term story. Not attend some brokerage conference in New York and Hong Kong and London and talk to FIIs as we know them, who own P-notes and are doing short-term hedging and all that stupid stuff. This is stupid money. The serious money has yet to enter India. And I can tell you this, the interest among the serious investors, as reflected in the quantum client list or potential client list, if you will, or the potential requests for meetings that we have, has increased dramatically. Because they know on a long-term basis, the Indian rupee has been whacked, so they get an advantage by their $1 buys more rupees and therefore more of the index. And they know that Indian earnings, in their view, are going to grow long-term, and they are going to be in India for the next 5, 10, 15, 20 years. So they see this as a wonderful opportunity to buy. Now, it may take them time. It may take them 6 months, 1 year, 2 years to get their internal processes, their approvals to allocate money to India. But, and of course, each cycle, when there is a negative, like there was post-Lehman, we saw from our client base, we saw a surge in client interest in India, or a surge in potential client interest in India. So every time there's a knockoff effect in India, we actually are very busy because we're trying to sell the long-term India story to sensible long-term investors. We have no clue, we have no views on what the global cues will be and global flows on a daily basis. And we have no interest. We focus on GDP long-term. We focus and we try to understand the freeze or unfreeze on policy making and its impact on the long-term GDP. And we focus a lot on the company earnings and the quality of the management. If you have these in mind and a long-term view, your investment in shares should give you more return than bank deposit because you're taking more risk.
Yep.
A bank deposit, especially with a PSU bank, is less risk, and therefore you should earn a certain rate of return from that, 6, 7, 8, 9, 10, whatever it may be. If you invest in shares, you must earn 15, 17, 18%. Otherwise, you should not be investing in shares. But you may not get that return year on year, unlike a bank deposit. You will get that return depending upon earnings and sentiment and mood and wild swings and all that stuff. And there could be years like 2011, like 2008, where you're losing capital big time. And now's not the time to panic. Now's the time to understand, stay focused, disciplined, recognize why you're buying shares for earnings in the long term.
I noticed every time we meet you and we ask you this question in times of crisis, and the serious monies tends to get more interested in India. Based on this, if you were to try and make, I know a couple of years back, I think it was again a crisis period in 2008 in November, I think we interviewed you and you said the index could actually multiply 4 times in the next 5-10 years. Do you think even after having seen the kind of growth in the 90s, the first decade of this century, do you see, what kind of returns do you see over 5-10 years? Very macro numbers.
Again, it'll be the same what we've seen in the last few decades, which is a 17 to 18% rate of return.
Do you think that's possible?
That is very much possible. Because you look at the numbers very simply. If your GDP growth in real terms is 6.5% per annum, to that you add inflation. So inflation is 6-7%. So your top line of the GDP in nominal terms, inflation at current prices, is growing by 13%, right? Okay. If your top line goes all the way down to your profit figure, right? Assume that, make a wild assumption. Top line goes all the way to increase in profits. That's a 13% growth in profits. Now, if you assume that smart fund managers with all their resources, all their research analysts, all their suited and booted stuff and Excel sheet power can identify companies that are doing better than the average, better than the peers, if you will, and they can sweat their assets more, they can do something, they got better product, whatever it may be, better management, better skills, they can grow faster. So they won't grow 13% top line, they'll grow a little faster than the average, and therefore that again translates down to higher profit. So it should be not too difficult to get a 15, 17, 18% growth in EPS from those companies, and therefore a 15, 17, 18% growth in your portfolio over time. Not in any 1 year, not in 3 years, but over time.
So if you had 100 rupees now, how would you allocate between various assets?
Well, at the bottom of each honest truth, there's a table. And I would sincerely urge people to follow that table. I don't have one magic number for everyone. The one cloud that is out there is, depending on your risk level and depending on your monthly needs of money, keep aside that many months' expenses, what we've been saying for a long time.
Yes.
If you are spending 20,000 rupees a month and you feel that you don't want to change your lifestyle no matter how bad the world is for the next 12 months, then keep 12 into 24, 2.4 lakhs aside. And the rest of your savings is 80-20. 80 equity, 20 gold. Or 85 equity, 15 gold, whatever you feel like, that's up to you. But that's what I'm doing with my life, and I've continued this right through different, crises, if you will, is this ratio. I work out my risk level, and my risk tolerance level is actually pretty low. I'm in a risky business of giving you all advice, of managing money. If stock markets go down and remain down for a long time, our fees as a company go down, my salary goes for a toss. Right? So therefore my risk level of my savings is very low. And therefore I like to keep more money in safe places. So I'm not talking about FMPs, I'm not talking about corporate debt, I'm talking about PSU banks. Very basic stuff. PSU banks. The rest of my money is roughly 80% equity, 20% gold. That's where I've kept my money.
Perfect. One final question. Any books you'd like to recommend to our readers? Across the spectrum, not just investing. Could be investing, could be others.
I think there are a couple of documentary films that I'd love to recommend. One is called The Inside Job, which I hope by now everyone has seen, because that tells you how rotten the field of finance is. The other one, which is very interesting, is one about, it's called Why We Fight.
Okay.
Why We Fight. It's a documentary about why the US had gone to war in the Middle East recently, why it went to why it went to Iraq, why it went to Afghanistan. It's a very good movie. It's a very good documentary film. You all must see that, in my opinion. Among the books, of course, I think Michael Lewis's book, The Big Short, which is out there. There's another book called The Empire of Trust, not to be confused with Bill Bonner's highly recommended and classic and fantastic The Empire of Debt. But this one is The Empire of Trust. I think it's by Tom, I'm going to get the last name wrong. I think it's Madden, but you'll have to excuse me on the last name. Can't remember. But it's called The Empire of Trust. And it is a fantastic book. It talks to you about how over centuries empires have come and gone, and why the US will still remain an empire for a long time. And it may be on a decline, but is nowhere dead. And much as I'm negative on the US economy in the near term, and much as I feel that the US dollar strengthening since August downgrade of S&P is wrong, I am a very long-term believer in the US, because they have the system to get out of their mess and come clean, which most economies and countries of the world don't have. So I'm optimistic in the US in the long run, and which is why I think the Empire of Trust sort of looks at the US as a long-term story in some sense. I think these would be the sort of books or documentaries that that one should look at. And recently I picked up a book called India Since 1980s, which talks about how policy making in India since the 1990s, written by two authors, which talks about how India has changed since the 1990s, not only on the economic side, but even the social side, and even the military policy making side. So that's an interesting book. It's a bit heavy. Some chapters are a little. I took out a dictionary actually, and I had to sort of mark 4 or 5 words in every page in a few of the chapters, because they've been written by someone who's into sort of high flying English, I guess. But it's an interesting book.
Okay, Ajit, that'll be all. Thank you very much for your time. Very helpful, and I think as always your suggestions about what to do with money, and I think these books will be pretty interesting, the documentaries and the books. Last time you recommended Inside Job, I think we probably got a few hundred mails from people saying what a brilliant documentary it was, brilliant movie it was. So I'm sure there'll be a lot of feedback this time as well.
I strongly urge SEBI to make it mandatory viewing, that every brokerage house, every distributor should ask every investor a question: have you watched the Inside Job, yes or no? If no, then you don't qualify for investing until you tick the box that you marked it. It is an absolutely eye-opening film, and I think it's a very powerful message in the film.
Okay, on that note, Ajit, thank you very much once again.
Thank you.
Thank you, ladies and gentlemen, for participating in the Equitymaster Web Summit. I'd like to take this opportunity to request you for your thoughts and feedback so that we could improve this Equitymaster Web Summit initiative even further. We did our first Web Summit in November 2008, and since then we've come a long way. We literally have tens of thousands of people who sign up for our Web Summit, and it's very encouraging, and a lot of you send in your questions or your feedback. Thank you for that. Tell us more and we'd be happy to improvise, and you can, as always, write directly to me at rgoel@equitymaster.com. If you'd like to share today's Web Summit with your friends and family, you could click on the links below. I'm not sure how long the Web Summit will be available for, but we'll ensure that they get access to at least some portion of it so that they too can benefit from it. So to conclude, once again, thank you very much for participating, and happy 2012.